So this is brief exercise 3-9, prepare and post transaction and adjusting entries for unearned revenue. So in order for us to recognize revenue, we have to have done something. We have to have met our performance obligation. We need to earn it. So in this case, this is an insurance company that sells insurance policies. So they have to provide insurance over the period of time the person purchases the insurance policy for. So if they pay up front or they pay the insurance policy at the beginning of the year, they still owe them the insurance for the full year. So we can't recognize that revenue because we haven't done what the customers paid us for. So we are going to set up when we deposit before we do anything, we set up unearned revenue, which is a liability. We owe them a service, and then at the year end, when we're doing our adjustments, we see if we've earned any of that revenue, and we would then record it. So let's start this question. So on March 1st, 2017, Big North Insurance received $4,800 cash from Erie Co. for a 1-year insurance policy. Big North has an October 31st year end and adjust accounts annually and complete the following. So first we're going to do the March 1st entry. So on March 1st in 2017, we received cash from the customers of $4,800 for the insurance policy, but we haven't provided the insurance for the year. So we record that as unearned revenue, which is our credit. It's a liability, so it's a credit. To increase a liability, we credit it. So we got cash in increases the debit, so we debit it, and then we credit unearned revenue. So that's recording our unearned revenue for the deposit we received from our customer. Then it asks us to calculate the amount of revenue earned in 2017 and the amount unearned at October 31st, 2017. So again, March 1st to October 31st is how many months? March, April, May, June, July, August, September, October. If you were following along and counting on your fingers, that is 8 months. So they have provided 8 months of the 12-month policy. All right, so they've earned 8 of the 12 months. So the full policy is $4,800. We divide that by 12 months, and then we multiply by 8 months to figure out that we've earned $3,200 of the insurance policy. We've covered 8 months, or 8/12. The unearned portion remaining is $4,800 times 4 months, or 12 minus 8, which is 4. So what's left is 4 months. So if we add those up to double check, 32 plus 1,600 is 4,800. So we've allocated them all. So that's what we're going to allocate on October 31st. We've now earned 3,200, and we still owe them service for 4 months, which is worth 1,600. So on October 31st, we do our adjusting entry to say we've now earned revenue. We're going to recognize it. We want to bring our revenue up to date for the year, so we have to show that we've earned it. So if we've earned it, we reduce our unearned revenue because it's no longer unearned. We've earned it now for 3,200, and we enter it into revenue. We've now earned that, so we're going to record the revenue. So we're going to debit unearned revenue and credit revenue. We're going to increase our revenue and decrease the amount we owe them. Okay, so that was C, and then it asks us to use T accounts to post the entries for A and B. So they said ignore cash, but we would credit 4,800 when we set up the deposit. So we receive the deposit, we would set up unearned revenue. Then when we earn it on October 31st, so that was March 1st, we would then credit on debit on October 31st, 3,200, which means 4,800 minus 32, we still owe them 1,600, which is what we've calculated here. and then on October 31st we would recognize the revenue of 3,200. So at the end of the period, we'd have 3,200 related to that policy. So again, at year end, our adjusting entry, we need to bring all of our revenue up to date. So we have to look and see, look at our unearned revenue account and see if we've earned any of that revenue.